Today we'd like to briefly update our research on Fiat Chrysler. So as we wrote a couple weeks ago, it's best that shareholders buckle up given the pretty terrific performance management has been generating. Now you've no doubt heard the media portray Fiat as being in trouble because it took a penalty for some recall issues. First of all, this is all in the rearview mirror as it took €650 million of charges last year to deal with these, some of which it was held to a higher standard than Ford and GM. The company hasn't complained about this and it's fully reserved for it. The penalty relates to Fiat narrowly missing a 60-day window to notify vehicle owners of a recall. In less than 2% of cases, it missed it by a few days. And while the company is taking it very seriously, it's not as serious as the media reports would have you believe. Plus, it's immaterial to the financial profile of Fiat going forward. There have been a lot of false accusations that the company is desperate to merge with another OEM because it's at risk of missing its 5-year plan. That couldn't be any further from the truth as they're about to hit their 2018 goals in North America and Europe over the next 12 months. As Chrysler has refreshed the ancient vehicles in its lineup, it's been able to lower the incentives needed to keep these cars turning on dealer lots. We flagged this back in August of 2014, and the pricing tailwinds in the most recent quarter have gathered pace, helping North American profit margins expand from under 5% last year to nearly 8% in the second quarter. Additionally, auto sales in Europe, especially Italy, have started to recover, and Fiat is taking market share in most markets, just as Italy's share of the European market has started gaining ground. Turbocharging this European recovery will be the renaissance of Alfa Romeo, which will begin at the end of this year. This stronger US pricing, coupled with a recovering European auto sales environment, will be driving FCA's operating income significantly higher than the current consensus predicts. Unsurprisingly, analysts were caught like deers in the headlights at the sight of this operating performance in the second quarter.
Sure, thank you very much. Can I come back on the NAFTA performance and ask you candidly what has changed sequentially so dramatically to drive such a move in profitability?
CEO Sergio Marchionne infamously loves to test the limits of the fast, red Italian cars that his company makes, and cars that go from 0 to 60 in 3 seconds typically don't mix well with Deere.
Analysts have consistently underestimated the earnings power of Fiat. So cars like this one, which transact for a few $1,000s above their competitors, will generate higher incremental returns on capital than the company's already producing. Same can be said for Jeeps and Maseratis. So because we paid less than 3 times cash flow for the shares, and Sergio is reinvesting all of this cash on an annual basis, the returns that he generates from his spending will drive our longer-term returns in the stock.
All of this is leading to both pronounced operating income expansion and production growth with these key model introductions and refreshments. This will have the effect of also lowering FCA's indebtedness. Margins and debt are the 2 primary factors frequently cited by bears who remain convinced FCA is a short. Both key arguments are going away in the next couple of quarters.
The company will be selling 10% of Ferrari in an IPO this October, creating a limited availability of shares, pretty similar to these cars where waiting lists can stretch a few years.
This creates a dynamic similar to art or Bordeaux wine in that the asset appreciates in value after the customer takes delivery. Given other luxury producers of fine wine and exclusive products trade at 5% cash flow yields or over 20 times EBITDA, and other inferior luxury auto brands have transacted anywhere from 9 to 11 times, we believe shares of Ferrari should settle trading somewhere in the low to mid-teens, which would translate to a value of $450 per FCA share. Yet one can't rule out the valuation getting a little bit silly as the global fan base of Ferrari is enormous and the brand's presence is so important that it gets paid by Formula One just to show up to the race. This fan enthusiasm is similar to Manchester United's fan base, who ironically also sold 10% of the company in its New York Stock Exchange debut, and it trades at almost double our estimated valuation for Ferrari. If we adjust FCA's valuation for the Ferrari transaction, scheduled to happen in a few short months, we can see that it trades for just 1.6 times next year's EBITDA. That compares to major competitors with inferior management teams and growth prospects trading at or above 4 times.
One of these things is not like the others.
If we valued FCA at a similar level to GM, it would add an incremental €17 to our fair value on top of the nearly 15 today. Remember, this is above and beyond the €4 to €5 we'll net when Ferrari shows up in our account.
So with the recovery in European auto sales, the spin-out of shares of Ferrari, and lower North American incentives, the next 6 months are surely going to be very interesting ones for shareholders of Fiat. You better make sure you buckle up.